In episode 4, we are going to talk about swing highs and swing lows, which are also called old swing highs and old swing lows. This is the easiest and the most powerful liquidity pool in the market. I will break down why most traders fail to choose the right liquidity pool when using these highs and lows. So let's get straight into it. So basically, what we understand by swing highs and swing lows is that a swing point is a three-candle formation, where the middle candle is either higher or lower than the candles on both sides. For example, if you look here, you can see some examples of swing highs and swing lows. These are the swing points that we are going to pay attention to. However, there is one important catch. We do not need to mark every single swing high and swing low that the market creates. Yes, many of them can give reactions when price returns to them, but most of the time the reaction is not strong enough to give the move we are looking for. So the question becomes, which swing points actually matter? The swing points that matter the most are the ones where price created strong reversals. In other words, the major turning points of the market. These are usually the outermost swing highs and swing lows, where price clearly changed direction. These swing points can appear on any time frame. It could be the 15-minute, 1-hour, or 4-hour chart. The important thing is that they must align with your bias. For example, if your bias is bearish, then even a lower time frame swing high, like a 1-minute swing high, can work as a level for price to react from. But if your bias is bullish, then looking at a 4-hour swing high to short from would not make sense because it goes against your bias. So the key idea is to always align the swing points you are using with your overall market bias. Now let me show you some examples of how these important swing points can give us the moves that we want to trade. Before I explain how to use these swing points in the market, there is one thing you need to understand. I personally only use these swing points during the New York AM session. You can use these points during other sessions as well, but I personally prefer trading the New York AM session because the New York session is usually the most volatile session of the day, and I personally like trading when there is more volatility in the market. So as we move through the day here, the first thing we are going to do is mark the 9:30 New York open time. Now before we start looking for swing points, we first need to determine what our bias is. If we move to the daily time frame, we can see that price is currently inside this daily inverse fair value gap. Because of this, what I am expecting is for price to respect this inverse fair value gap and continue moving lower. So because of that, my bias is bearish. Now if we move down to the 4-hour time frame, we can see that we have a swing point just below the daily inverse fair value gap. So this is the swing point that we are going to be paying attention to, and we will be waiting for price to retrace back into this swing point. Now after identifying that, we move down to the 1-minute time frame, or any time frame that you personally prefer for execution. At this point, we simply wait for the 9:30 New York open. Now after the 9:30 open happens, the next thing we want to see is price sweeping the high. At first, price does not sweep the high, so we continue waiting. Then around 10 a.m., you can see that price sweeps the high. Now after the liquidity sweep, what are we looking for? We are looking for confirmation. Moving forward, we can see that we do get confirmation. We have a change in state of delivery, and we also have a fair value gap forming. This confirms that our bearish bias was correct, and now I can comfortably place my trade using that fair value gap. For my targets, I can simply target the lows below. And if we move to the 15-minute time frame, you can also see that this looks like a power of 3 model. We have accumulation around the 9:30 open, then manipulation around 10 o'clock, and now we are expecting the distribution phase. And as you can see, price moves beautifully straight into the targets that we were looking for. Now let me show you one more example of how you are going to use these swing highs and lows, and how to identify the swing points that actually matter. Just like before, the first thing we need to do is determine the bias. If we move to the daily time frame, what do we see? We have a bearish fair value gap, and because of that, I expect price to respect this fair value gap and continue moving lower. So my bias in this situation is bearish. Now if I move down to the 1 hour time frame to look for the swing high that we want to focus on, you can see that it has already been swept. Here we have a clear buy-side liquidity sweep, and this happens before the 9:30 New York Open. As I mentioned earlier, I personally only take trades after the 9:30 Open, so we are going to wait for the market to open before looking for any entry. Now here we have the 9:30 Open. After the Open, the next thing we want to see is what price does around that swing point. You can see that price sweeps the high again, which clearly shows the fractal nature of price. So now everything is starting to align. On the daily time frame, we have price inside a bearish fair value gap. On the 4-hour time frame, we already had a buy-side liquidity sweep. And now on the 15-minute structure, we also see liquidity being taken. All of this is aligning with our bearish bias. Now the next thing I need is confirmation on the 1-minute time frame. As price moves forward, we do get that confirmation. We see an inverse fair value gap form, and we also get a change in state of delivery. At this point, I know that my bias is still valid, and I can comfortably place my trade using that inverse fair value gap as my entry. For my targets, I am simply going to target the sell side liquidity resting below. Moving forward, you can see how beautifully price comes back to activate my limit order and then move straight into the targets that we were looking for. So this is how you are going to use these significant swing highs and swing lows in your trading. All right, so that's how you use significant swing highs and swing lows in your trading. The key idea is not to mark every single swing point on the chart, but to focus on the important turning points where price actually reacts and creates liquidity. Always start by identifying your bias on the higher time frames, then wait for price to reach those significant swing points, and finally look for confirmation on the lower time frame before entering the trade. If this video helped you understand swing highs and swing lows better, make sure you like the video, subscribe to the channel, and share it with someone who wants to improve their trading. And with that being said, I'll see you in the next one.